exactly how a 60-year trillion-dollar empire was built. And here's a hint. It wasn't built on some static, rigid math formula. No, it was built on an evolving, deeply human psychology. We're mapping out the value investing engine behind Warren Buffett. It's just a completely fascinating journey of constant learning, massive adaptation, and above all else, relentless patience. Let's get into it. Okay, let's dive into this. Because $55 million, well, that's exactly where our story begins. That is literally what a single $1,000 bet on Warren Buffett back in 1965 would be worth today. Just let that sink in for a second. An ordinary person with just $1,000 could have secured absolute multi-generational wealth simply by backing this one guy's mind over the span of a lifetime. It's crazy. Which naturally brings us to this massive question. How? How did one person beat the market for 6 whole decades, creating the greatest compounding machine in human history without relying on algorithms or supercomputers or high-frequency trading? Well, he pulled off this completely unprecedented feat without ever actually playing by Wall Street's traditional rules. He basically built his own game. And to understand that game, we really have to look at how it evolved. Part 1. The cigar butt strategy. To understand this massive empire, we have to start at the very beginning. This is where Buffett started out under the wing of his famous mentor, Ben Graham, at Columbia University. It was a strategy totally rooted in cold, calculating, and purely math-driven bargain hunting. Now, what's really interesting about this slide is the actual definition. Cigar butt investing is essentially finding a pathetic, often dying company selling so incredibly cheap that there is exactly one good free puff of profit left in it. Buffett used this philosophy to squeeze quick, basically riskless profits out of totally obscure businesses. For instance, he found Sanborn Maps, right? A struggling mapping company whose stock traded at $45, but it was sitting on a hidden investment portfolio worth $65 a share. Or take Rockwood Chocolate, where he pulled off this brilliant arbitrage play involving cocoa beans just to avoid paying taxes. In these early days, it was purely about unlocking hidden mathematical value. No emotion, just raw numbers. Part 2. The Berkshire Mistake. This is where we hit a massive turning point. See, the cigar butt formula had a huge flaw. Actually, scratch that. It had 2 flaws, really. First off, it simply didn't scale as his wealth grew. I mean, there are only so many cheap cigar butts lying on the street, right? And second, it totally ignored human emotion, which led to some pretty devastating early missteps for Buffett. The Dempster Mill crisis is a prime example of a genius falling victim to a seriously flawed framework. Buffett bought this failing windmill company in Nebraska simply because it was dirt cheap on paper. To unlock that value, he brought in completely ruthless management, fired hundreds of workers, and shut down branches just to liquidate enough assets to survive. The result? The entire town of Beatrice, Nebraska, violently protested. They absolutely hated his guts, viewing him as this heartless liquidator. Ultimately, the locals actually raised $3 million to buy the company back from him just to get him out of town. It was a very harsh reality check that you can't just operate on a spreadsheet. Reputation, relationships, and human impact actually matter. But his emotions got the better of him again, and it led to the biggest ironic twist in finance history. He literally bought a dying textile mill out of pure spite. The company? Berkshire Hathaway. The CEO at the time, Seabury Stanton, had promised to buy Buffett's shares back at $11.50, but then tried to cheat him out of a few measly pennies on the final official tender offer. Furious at being slighted, Buffett bought a controlling stake in the whole company just so he could fire Stanton. So yeah, he won the battle, but as a result, his crown jewel was now a terrible, doomed textile business that was just bleeding cash. Part 3. Building the float machine. Okay, so he needed a way out of this dying textile industry, and this marks a total paradigm shift. This move fundamentally saved Berkshire Hathaway from going totally under, and it was a strategy brought on entirely by his new partner, the incredibly brilliant Charlie Munger. And this brilliantly illustrates the evolution of his entire psychology. He moved away from his old mentor Ben Graham's rule of buying fair companies at great prices, which, was the classic cigar butt method. Instead, Charlie Munger introduced the ultimate upgrade, buying great companies at fair prices. Munger essentially convinced him that time is the friend of a wonderful business and the absolute enemy of a mediocre one. He pushed Buffett to stop buying these dying businesses and start focusing on genuine quality. Now, to actually fund this new quality-focused strategy, they discovered a secret weapon: float. So what is float? It's simply idle cash held by a company that can be put to work in other investments before it actually needs to be paid out. They found this first with blue chip stamps, an old loyalty program, and later with massive insurance giants like Geico.
This float was, for all intents and purposes, free leverage. They could invest massive amounts of premium cash without ever having to borrow a single dime from a bank or pay a cent in interest. Talk about a total game changer. Let's walk through the exact float playbook, because the mechanics here are just pure genius. Step 1. Collect the cash up front from your customers. Back in the day, that meant trading stamps, but today, think auto insurance premiums. Step 2. Hold that massive pool of idle cash. You just sit on it while you wait for claims to roll in. Step 3, and this is the real magic trick, invest that idle cash to generate profit strictly for Berkshire Hathaway. And finally, Step 4, pay out the customer claims much, much later down the line. They took these incredibly complex financial mechanisms and turned them into a beautifully simple, infinitely repeatable recipe for unbelievable wealth. Part 4, Castles and Moats. So now that the float machine was pumping out billions in free cash, where exactly did they park it all? Well, Buffett and Munger completely shifted their focus to targeting enduring, cash-flowing businesses to protect and grow that massive capital base. Buffett summed it up absolutely perfectly. If you've got an economic castle, people are going to come and want to take that castle away. You better have a strong moat. See's Candies was basically the ultimate test subject for this philosophy. It wasn't just a candy store. It was a beloved, iconic brand with a deeply enduring competitive edge. People loved it so much they would happily overpay for a box of chocolates every single Valentine's Day, year in and year out, totally ignoring inflation. That intense brand loyalty, that's the moat protecting the economic castle from competitors. And to actually acquire these castles, Buffett relied on one absolutely core metric: intrinsic value. Basically, this is the true, fair value of a company. It's totally separate from whatever wildly high or low prices the stock market happens to be throwing at it on any given Tuesday due to irrational optimism or blinding fear. Buffett's entire goal, his absolute greatest skill, was simply waiting patiently for a great company's price to drop below this fair intrinsic value before striking.
Part 5, Profiting from Panic. So you might be wondering, when exactly do prices drop below their intrinsic value? Well, usually it's during a severe, widespread crisis. Remember how much the town of Beatrice hated him during his old cigar butt days? Well, Buffett definitely learned from that. He spent decades painstakingly cultivating a brand new intangible asset, a pristine, untouchable reputation. He became known as the conscience of American finance, a trusted white knight. And that spotless reputation allowed him to profit enormously when everyone else in the room was absolutely terrified. Let's move to and see how this builds. Just look at these macroeconomic panics. We've got Black Monday in 1987, the tragic aftermath of September 11th in 2001, the horrific 2008 housing crisis, and the 2022 tech and crypto crash. For average investors, these events were total, absolute nightmares. But for Buffett, they were purely event-driven catalysts. It was exactly during these panics that he was able to swoop in and buy undisputed giants like Coca-Cola and Goldman Sachs on massive, massive sales. Why? Because he was the only guy in the room with a cool head and a giant pocket full of cash when liquidity completely dried up everywhere else. And because of that pristine reputation, he got sweetheart deals that no one else on Wall Street could even dream of. We're talking about securing a guaranteed 15% riskless return just for renting out his halo of trust during massive panics like the American Express salad oil scandal and later the Salomon brothers treasury bidding scandal. Just having Warren Buffett publicly step in, invest some money, and vouch for the company, it immediately restored the market's confidence. He essentially earned these massive, riskless profits simply because his personal brand was just that untouchable. Part 6, the compounding engine. This brings us to the finale, covering the massive scale of Berkshire Hathaway's late-stage growth, his almost superhuman patience, and the inevitable handoff to the next generation. These late-stage moves are just endlessly fascinating to watch. Look at this. In 2008, he casually bails out Goldman Sachs by writing a $5 billion check at the absolute peak of the financial crisis. Later on, completely breaking his old rigid rules about avoiding technology, he pivots and takes this massive, wildly successful stake in Apple. Tragically, in late 2023, he loses his architectural partner, Charlie Munger, the guy whose literal job was to tell him no for 6 decades at age 99. And then, during the absolute euphoria of the 2024 AI boom, what does Buffett do? He quietly walks away from the table, aggressively slashing his Apple and bank stocks while literally everyone else is buying. So, the crucial point is this staggering number right here, $382 billion. By late 2025, that was Berkshire's cash pile.
That's enough to fill a ridiculous number of bank vaults. Wall Street completely panicked, thinking Buffett was predicting some massive, apocalyptic market crash. But no, he wasn't trying to time the market. That cash pile was a deliberate, incredibly thoughtful inheritance. He knew he was stepping down, and he wanted his successor, Greg Abel, to start his reign with more firepower and flexibility than any new chief executive in corporate history.
And here is the final mind-bending statistic that wraps up this entire legacy. 20%. A nearly 20% annualized return compounded for 6 uninterrupted decades. Put that in perspective. He effectively doubled the broader market's performance, and he did it all with 0 leverage blowups, 0 massive corporate scandals, and absolutely no lost decades. He built a compounding machine that is so perfectly robust it's going to run smoothly without him even at the helm. I want to leave you with this ultimate test of the value investor. When the market crashes and everyone else around you panics, do you have the absolute patience to do nothing until the perfect pitch arrives? Because as we've seen today, the true secret to a trillion-dollar empire isn't some highly complex math formula. It's extreme emotional discipline, continuous evolution, and the unwavering willingness to wait for the exact right moment. Thanks so much for joining me on this explainer, and honestly, I hope it changes the way you look at your own financial journey.